Let's talk tech and investing today with the chief equity market strategist with Federated Investors, Phil Orlando. Phil, great to see you.
Thanks for having me back.
Your reaction to the earnings season and the strength in technology that we're seeing this week?
It's a phenomenal earnings season. We're about halfway through. Revenues are up about 10 or 11% year over year.
That's good.
Earnings are up about 25 or 26% year over year. This is the fourth good quarter in a row we've had. This is the best that earnings have been since 2011. Contrast that with the earnings recession that we were in not too long ago that lasted for 7 quarters through the middle of 2016. This is phenomenal. Stocks, we think, should be moving up to reflect the strong earnings, but it's been terrific, and about 7% of that earnings gain is reflected the tax changes that we saw at the end of last year. And companies have been talking that through in terms of the guidance. So I think the fiscal policy initiatives that the administration put in place at the end of last year will have long-ranging effects. We think earnings over the full year could be up about 20%.
That's a huge number. Would you buy into stocks on that phenomenon?
What we actually did right at the end of March, stocks were sitting right around their 200-day moving average. They looked cheap to us, down around 16 times earnings or so. We added a little bit more to equities, specifically small cap growth. And obviously there are some technology companies that are in that mix.
Yeah.
Phil, Facebook and Amazon came in so strong this week, and I think that was significant given where we've been with those stocks over the past month or two, all the concerns at a political level, and yet their earnings were very strong. Facebook, 70 million new daily active users in the first quarter. Is that going to put a lot of these political concerns to bed when it comes to the FANG stocks, or is this just a temporary blip, good news for these companies?
That's the whole separating the wheat from the chaff stuff. So the political noise is what had knocked down Facebook. The reality is that underlying fundamentals were pretty good. Now, what we don't know is will some percentage of their user base decide not to use them because of the political nonsense.
I push back on that. That's not political nonsense. This is a company that basically abused the data of its very customers and was not honest with them for more than a decade. And so now the world got wind of it, finally, with this one Cambridge Analytica scandal.
They may find more regulations as a result of this.
It's regulation, but the question is, do advertisers go somewhere else or try to find somewhere else?
But they haven't.
Not for the first quarter, but again, a lot of this unfolded after the quarter ended.
Exactly. Only 2 weeks of the Cambridge Analytica scandal was baked into this. And so you also have regulations going into effect May 25th from Europe. Goldman Sachs estimates that the European Union's regulations are going to impact Facebook's revenues to the tune of 7%. And that's just on the revenue side, not on the cost side. And you need to think about the type of advertising which delineates Facebook from Amazon, right? Amazon actually has purchase history. Facebook tries selling you affiliated marketing with Miracle Diet Pills, instant muscle builders, brain boosters. They're all fake, right? And think about it. The quarter was so good on the advertising side because all that affiliated marketing was bought before the new rules and regulations came into effect from Facebook on itself.
So what's your point?
So my point, my point is Facebook's quarter was great, but it's the last great quarter they're going to have because they have Amazon nipping at their heels.
Do you agree with that?
Well, let me help Kevin out here. The timing issue here, I think, is significant. That what happened in Washington came right at the very end of the quarter, and that quarter was largely baked in. So there's likely to be a couple of quarters of instability here in terms of what's going to shake out. I think that by the time we get into the fourth quarter, technology, generally Facebook in particular, will be okay. But we're going to have some chop here for the next couple of quarters.
So are you a seller here?
Yeah, I'm a complete seller. Their multiple will compress. They're not going to grow at the top line. Their margins are going to compress. So they're not worth 22 times forward earnings. They may be worth 18 times earnings because guess what? They know what you like and your habits, but guess what Amazon knows? They know your likes, your habits, what your purchases are. More traditional brands are advertising on Amazon now than independent brands and Amazon itself.
Giving them nice room to increase prices, Dagan. Amazon announcing a 20% increase in the annual membership price. Members are now going to start paying $119 a year. That begins in the next 2 months.
They locked us in, and now they're jacking the prices, which is what a giant company can do. But to Kevin's point, I do want to note that Amazon's that it's better than expected results were from particularly with the revenue growth, were from the cloud division, but also, as you said, strong growth in the company's advertising.
It beat expectations.
Well, we saw the advertising business do well at Facebook. I mean, all week we've been seeing the ad dollars.
Right, $2 billion for this quarter alone. It was estimated to be $3.4 billion this year. Right? So it's gangbusters.
But that was the point I was trying to make. Is you can't dismiss Facebook's problems as just something concocted by Washington.
Right.
They've been showing a reckless disregard for people's privacy for more than a decade, and finally somebody opened the garage door, if you will, and we're seeing them standing there naked.
And we'll see what this means over the longer term, because I mean, it could mean structural change for the way they do business, and that impacts the earnings story. Phil, before you go, there is a narrative going on right now where this economy slows down considerably in the end of 19 and into 20. Do you believe that? Because as rates start going higher, which we know is happening with the Fed, are they going to slow things down from like a 3% year this year to 1.75% in 1920?
The short answer is no. Look at first quarter GDP today. We're at 2.5%. The street's at 2%. The number will come in light because January and February numbers, which is the basis for today's report, will be light. We're at 2.5% because when the March data comes in on the revisions for both trade and the consumer, those numbers will come up. We will get a bounce in the second quarter. We're expecting 3% GDP growth this year, 3% GDP growth next year. We think that 3% we've seen last year in the last 3 quarters is sustainable.
Good stuff. Phil Orlando, good to see you. Thank you.